In this video, we're going to concentrate on thinking about the next step in making decisions, right? We've talked about trying to decide which assets to buy. Now we want to talk about the financing aspect of the company. So we're going to start with a theory, and this is a capital structure theory that assumes a perfect market. And we'll define that a little bit further later on, but essentially this is a market that has no taxes. Other things, but this is the primary characteristic that we're interested in when we think about financing. So here's capital structure. Assume we have a company that it's going to cost $800 to do a project. And if we have a strong economy, we'll make $1,400 in cash flows, $800 in a weak economy. And we're going to assume that they are equally likely. So the first question we have is, what is the net present value of this opportunity? As a result, right, we know that nothing in the world is necessarily risk-free, but if we assume a 10% risk premium and a risk-free rate of 5%, then we have a discount rate of roughly 15%. The net present value of this project is $200. So again, that gives us the opportunity, obviously, to increase the wealth of the company. So how do we get this 1150? So let me go on that before I go forward. Essentially, the 1150 is 50% of 1400 plus 50% of 900 is that 1150. So again, if we can raise $1,000 by selling equity from the firm, after we pay the investment cost of $800, what this tells us is essentially you'll have $200 left over. That's the net present value of the project. So if it's unlevered, right? Unlevered equity means there's no debt. Then again, if the initial value is $1,000 and strong economies $1,400, weak economies $900, then what is the rate of return? So again, 50% of 40% and 50% of negative 10 gives us negative 10%. So if you look again at the average, how you calculate that, this unlevered project has a return of around 15%. And because the cost of capital is 15%, right, we're getting the right kind of return for the risk that we're taking. Now, suppose we decide to borrow $500 initially. Right? So in addition to selling equity, right, we're going to borrow $500. So because the cash flow is always going to be enough to pay the debt, in other words, this is risk-free debt, there's a guaranteed payment in debt of $525 at the end of 1 year. 5% of the $500 plus the $500. So now what we have is levered equity. So let's talk about what this borrowing does to the firm. So given the $525, and again, it doesn't matter the kind of equity we have, here's the cash flow that we receive. So solving for the missing part, right? 1,400 minus 525 is this 875. The law of one price, we've talked about a couple of times, but so look, if these two items are the same, if the cash flows are the same, then the value to the firm is the same. It's $1,000. So solving for equity, this levered equity now is worth $500. You just solve for the missing value. So again, what should it sell for? Again, we have the $500. what's the best capital structure for the entrepreneur? Well, again, it kind of depends on the entrepreneur. Depends on what they want. But in this case, it really doesn't matter what capital structure they pick. According to Modigliani and Miller, they've argued that the total value of the firm doesn't depend on capital structure. So the cash flows of the company still reflect the equal cash flows of the project. So therefore, there's no change in value for the firm. So in a world with this perfect capital market, we are saying that the capital structure itself does not matter. So again, here we just solve for that $500 equity value. Now, because the cash flows of the levered equity company are a little bit smaller, right, than those of the unlevered equity, right, it's going to sell for a little bit of a lower price. Again, 500 versus 1,000. However, you're not worse off. You'll still raise a total of $1,000 by issuing both debt and levered equity. So as an owner, as an investor, you'd be indifferent between those two choices for the firm's capital structure. Now, I agree that this is sometimes a little difficult to fathom, right? It's kind of hard to wrap your arms around this. But let's keep in mind that this perfect capital market doesn't exist, right? So we're just starting with looking at a sterile world. What does debt do to financing if we have this very sterile world? So what's the effect of leverage on risk? Leverage increases the risk to the equity. So therefore, right, since we now have an increase in risk for stock, that means that we have to have a different discount rate. The old 15% was inappropriate because now, obviously, the higher the risk, the higher the return that's desired. So again, the riskier the discount rate, the higher the previous amount to determine value is higher in the previous amount that we had. So now let's look. Here's the unlevered equity that we had, and that showed a 15% return that we calculated that earlier. But now if we have the levered equity, looking at the values that were created, in a strong economy, they would earn 75%. In a weak economy, they'd lose 25%. And that average, again, we're doing 50% of each, says now that the levered equity has higher risk, so it has a higher return. So now the expected risk on this levered equity increases to 25%, right? Used to be 15, now it's 25. Why? Because it is riskier, right? So the relationship between risk and return we can look at a little bit more formally. They talk about the risk premium. So for debt, the risk premium is 0%, obviously. Unlevered equity, 40 minus a negative 10, that's 50%. That's the change in return from best to worst. This is the range. Now, if you subtract the return, that means that the equity has a 10% risk premium. And now with the levered equity, we're showing a 20% levered equity. Because the debt's return bears no systematic risk, its risk premium is 0. We've talked about that many times. And again, in this case, the levered equity has twice the systematic risk of the unlevered risk. So that means it has twice the risk premium. So again, what does this mean in the end? In the case of perfect capital market, if the firm is 100% equity financed, the equity holders expect 15%. But if it's financed 50%, then the debt holders are going to receive 5%, but the equity holders are going to want more because it is a riskier company. So leverage increases the risk of equity even when there's no risk that the firm will default. Why is that? Essentially, what we're talking about here is just saying that even though debt is cheaper, it still raises risk for stock. Even if it's risk-free, it does increase the risk on stock. So that the average cost of capital then is going to remain, even though it changes, right? The average cost of capital with leverage is the same as for the unlevered firm. And we're going to talk about this a little bit more later. I just want to do this real quickly. We have a very simple formula. It says the value of the company is the free cash flow divided by the weighted average cost of capital. So what we're talking about with this formula, what we're trying to investigate in these theories, is what happens to this number. We're going to assume that free cash flow is not affected by the financing. But what is affected by financing is this weighted average cost of capital. And in this perfect capital market, what we're ultimately saying is that the ultimate cost of capital does not change when you change the capital structure of the company. I'll see you in the next video.